Time for FOMO, as we discussed Nvidia, and no stock has been more of the FOMO stock this year than Nvidia. You could said maybe C3 AI at times, but Nvidia running laps around the competition.
Even like running laps around like of the best performers in the S&P 500 this year, it's been like Meta and Tesla were like the second and third next to Nvidia. They're even running laps around those names. We're up 230% this year. We are down about 4%, a measly 4% from highs, but a name that's continuing to surprise to the upside. It's been a very fun story to watch, no doubt about it. We have been stuck more in a new range, but I would say that if I was a technical analyst, I'd actually like this because it's establishing some credence at this higher level, establishing a range that's up from like 430 to like 490 a share. I mean, that's not too bad for a stock that traded, around $100. I just recall the story's pitfalls about a year or 2 years ago. But news we got today is that they reportedly have found a way to sell their high-end chips to Chinese companies while still remaining compliant with U.S. rules that are aimed at curbing China's access to a lot of U.S. tech. China does account for around 20 to 25% of Nvidia's overall revenue in the data center business, so its biggest unit. This is huge for them. Nvidia is set to deliver 3 new chips to domestic manufacturers in the coming days. This is according to several sources we have gotten at this point, but these chips are basically based on Nvidia's H100 chips, according to this report. The H100 and A100 AI chips were the first to be hit by these U.S. restrictions last year that were aimed to curb these sales to China. Now, Nvidia said in September of last year, filing the U.S. government would still allow it to develop its H100 chip in China. So they were able to find a workaround last year. But then news we got, of course, over the last month then sent some things into somewhat of a tailspin because it was basically like more restrictions will now limit that H100 chip from being sold. That is a huge portion of their business, like I said. So right now we are only seeing these new chips capture about 50% of the power that had been in the A100. But no doubt about it, right now it's still a workaround. It's still a solution to what has been an ongoing problem. Even if it's a temporary solution, Alex, I think that this is read as a huge win because it was a concern. For a name that's up 230% this year, it's like, will it be able to continue to meet these really high expectations? China was perhaps seen as a near-term headwind. I think it still is. Right now, we're just seeing a workaround. Nvidia does it again, I guess.
What fascinates me most and I find just absolutely incredible about this company, I'm not going to cherry pick the absolute low, but let's just go to like the end of the year, beginning of this year, where the stock was trading around $140 a share. If you were to go to that point, the forward PE, which is a pretty common metric used for valuation, was nearly identical to what it is today, with the stock 3 times higher than that price at $481 a share, more than 3 times that price. That doesn't happen. That isn't normal to see a company not go up by 300% from a level, and the valuation didn't swell. The valuation has stayed the same. That is unmatched by really any company, let alone a $1 trillion company.
Well, that's what's so to be ridiculous about this is it's like, how does that happen? I mean, like that makes I think that's such a good point because valuation is something we talked about ahead of their last earnings event where it's like, all right, like at what point do we start to see things moderate? But the fact is actually their valuation, I think, makes it even more attractive of a story, right?
Well, the fact of the matter is they actually grew into this. The valuation hasn't changed. Yeah, along the way it swelled up, at points May of this year before we got those really impressive guidance figures and of course subsequent earnings. It did swell. So the first half of the year you saw this valuation forward PE swell to about 60, which would have been elevated objectively in a name like Nvidia over the last couple of years. But after we got the updated figures that really confirmed the move higher, it basically said, hey, these numbers warranted this move. And it explains why when you look at something like analyst price targets, it always really hurts my brain to think about, okay, the stock just went from $100, $110 to $500, and you still have analysts calling for $750, $600, $630. It's like, okay, enough already. The stock can't keep going that much higher. But in this case, you could make the argument that it could, because if this growth trajectory continues, it should go to that level. And Who knows if it can continue at the rapid pace of growth that it has, but 95.2% of analysts tell you to buy the stock after it's rallied 300%. Pretty impressive.
Yeah, and I think the street high price target is now like $800 a share. I mean, there's some that are thousands, but I think of the analysts that we look at, 700 to 800 is one of the highs. That's crazy, but I think that you make such a good point, and I think that's actually something that's, again, relatively attractive about Nvidia, the fact that it's grown into its valuation versus the other way around. A lot of companies right now, it's like their valuations were so much higher a few years ago, it's difficult to reevaluate them at this point. That's not the case for Nvidia, and they do have a really good growth engine behind this valuation, moderating or surging, catching up with itself, I guess is the best way to put it.